3 ways to plan for your future long-term care needs.
It's the hybrid long-term care plan versus the annuity versus, and we'll start with the last one first, what if you just do all this yourself?
But there's also some pros and cons, and I'd say it's not just like a cookie cutter response. Hey guys, I'm Derek Wilkins with LTC Tree. We're back here for another video today. I'm with my cousin, Drew Nichols. He's out in California, and today we're going to talk about 3 ways to plan for your future long-term care needs. Drew, what's going on?
Hey, Derek. Yeah, so today we're going to talk about here in 2025, a couple of ways that people are looking at planning for long-term care. And really it comes down to, for people who have assets, the hybrid long-term care plan versus the annuity versus, and we'll start with the last one first, what if you just do all this yourself? You don't buy any insurance, you don't buy any financial products, you're just a DIY kind of guy. So that's what we're going to talk about today.
Okay, well, let's kind of dive into, like you said, the last one you mentioned, and we'll talk about it first. The self-insure play, doing it yourself, you're basically positioning your own assets to plan for your future healthcare needs. And that's obviously very possible to do. But there's also some pros and cons. And I'd say it's not just like a cookie cutter response. It's really going to depend on a couple of variables. With the first one that jumps out to me, Drew, is having an honest conversation with yourself about your health. Like, I just talked with a guy last week. He's doing his 5th Ironman, I think in end of the month, and he's 59 years old, in great shape, no medications, good BMI. The likelihood that he's going to need long-term care in the next 10 years is pretty low. But sometimes we'll talk with people who are maybe they're a little bit overweight, maybe they have diabetes, maybe they have to have joint replacements. That's a claim that maybe could happen within the next 10 years. And so then maybe that's when you want to get the insurance. What are your thoughts on the DYI?
Yeah, so do it yourself is appealing because you don't have to navigate any complicated financial products. On its surface, it looks like, an interesting way to go. And it's frankly what most people do. The downside is really the leverage, or the lack thereof, I should say. With these insurance plans and even with the annuities, but particularly the hybrid long-term care plans, you get quite a bit of leverage if you need long-term care. So by that, what I mean is you can take say $100,000 premium and immediately turn it into $300,000 or $400,000 as a starting point on benefits that grow from there, and it's tax-free. So what you lose if you DIY is leverage. What you gain is autonomy. You keep that money in your account. You can do what you want with it. I think it's a good idea to be DIY with most of your money, just not all of it. What do you think?
Yeah, I like the DYI for people who have, I'd say 15 years or longer time horizon. Because, you're just making an educated guess. I mean, you're not going to get it right all the time, but like you just have to kind of try your best and just based on your current health, your parents' health, your grandparents' health, what's your likelihood of needing care, if you're 60 years old within the next 10 years? If it's pretty low, then you probably want to do it yourself, or maybe the third option we'll talk about here in a second. It's kind of something in between. Because then you have time on your side to let that money compound. Now, one factor you have to come into account with is taxes. Obviously, long-term care insurance benefits are paid tax-free, versus if you do self-insure, you have to pay taxes when you begin to take the money out, unless it's like in a Roth IRA or something. And so the taxes have to come into play, and also market timing. That's another thing that you want to factor in. Like, if you wanted to DYA in April of this year, when the market crashed, it could be a bad time to actually sell your stocks to pay for care. So that's another variable you have to factor in. So what is the number 2, way that people can plan for long-term care?
Yeah, so we've gotten do it yourself out of the way. It's the most common thing people really default to. What we really try to educate people on are the alternatives, and those are hybrid long-term care plans, which are for people who are healthy enough to qualify health-wise. But then a new entrant into the field over the last couple of years in particular, and it's an interesting alternative to hybrid long-term care plans, are income annuities. So you can't see it on camera, but Derek and I spend a lot of time debating, various products, and we sit down and talk about specific clients. Like, okay, I've got a 64-year-old lady who wants to start taking an income when she's 72 years old, but she's worried she might need long-term care because her mom's 95 and she's as healthy as her mom was. What should we do for her? We'll take a specific situation, we'll look at all the numbers. And so more and more over the last couple of years, Derek and I have been bringing these income annuities into the equation. So that's what we'll probably let's talk about that now.
Okay, yeah. So what the lifetime equity income annuities are is you take the same $100,000 and you allocate it towards an annuity. And what the insurance company will do is you give us X number of dollars, and at a certain point in the future, we're going to guarantee you an income for life as long as you live. And because annuities have gotten so much better the past 3 years, really because interest rates have been rising, insurance companies are healthier, they can pay you more benefits. There's features out there that whatever income that they're paying you, they'll 2x it for 5 years. Now, you do have to pay taxes when you begin to take the money out, but it is at annuities are taxed at your ordinary income tax rate versus capital gains tax rate. So a lot of our clients should be in that 12% tax rate when they do start taking taking the income from the annuity. But you do have to account for taxes, whether it's capital gains tax rates or income tax rates. You always want to factor in your tax burden. But yeah, so in summary, you put the money into an annuity, it grows indexed to common indices such as the S&P 500, the NASDAQ, the Dow Jones, and the hope is those indexes perform that 7, 8, 9, 10% each year over the next 15 years. But if they don't, that's where this lifetime income stream could come in, because the insurance companies now are guaranteeing anywhere from a 8% return up to a 10% return per year for the next 10 to 20 years. And that's going to vary between the companies. But that's kind of the safety net. And so you'll bank that, say 10% simple return each year for in your case, Drew, that lady who's 64 taking income at 72, she banked it for 8 years, and then she get a lifetime income stream based off that increased amount, which she can just rely on for as long as she lives. And it's almost like you're creating an extra pension for yourself. No matter how long you live, it's going to pay you X number of dollars. And that long-term care doubler is kind of just a nice extra bonus.
Exactly. And just to kind of round out that example, so with this one, she puts in $91,000 premium today. That's another difference we should talk about. The annuities are paid up front. There's no significant product on the market that allows you to slowly trickle money in that's going to be, of any value that we know of. So it's an uptime or one-time lump sum premium, whereas the hybrid plans, you can do a 5 or 10 year payment into it. But back to her example. So she puts the 91K in today. She'll have $12,700 a year starting when she's 72. That's doubled to 25,000. Now that's not going to cover all of her long-term care, of course, but it's going to be, helpful if she gets into that situation. So the key word on the taxes when it comes to the long-term care plans is make sure you're getting a plan that is 7702B compliant, in other words. So that means that you'll have tax-free benefits rather, and it's just most plans on the market are gonna qualify for that. So, all right, we've talked about how you can dollar cost average into a hybrid, how annuities are paid up front. And really what it comes down to, Derek, is they solve different problems more so than really being direct competitors. Wouldn't you say?
Yeah, it's just another tool that we have in our toolbox to kind of fit each person's situation. And the annuity, again, if you have don't have such good health right now, that's probably not going to be the best bet for you. Now, it is kind of a conundrum. So if you have really bad health, you're not going to be able to get long-term care insurance because you have to medically qualify. But if you have, you know, decent health, you still might get the long-term care insurance, but then you're just trying to figure out, okay, what's my realistic age of probably needing care? And so, it's really for somebody who's kind of stuck in between. They don't want to self-insure the whole thing, but they're at the same time they're still concerned about, hey, what if I do need long-term care? And the other component is just it's just a nice, if nothing happens to you and you have this annuity paying you this income, it's just a nice just extra bonus that you'll have in retirement to go have fun with. I mean, you could take an extra trip, go out to eat, and not really worry about it because you have your Social Security income coming in. This money can almost be the play money if it never comes to you needing long-term care. And you can also know that it's just growing, protected against market losses. Now, the third item I want to go back to, Drew, was let's talk a little bit more about the third option. What is hybrid long-term care insurance for those who are kind of new to this? What is it? I know you touched on it briefly earlier, but let's drill down a little bit more on that.
Yeah. So what you're going to do typically is pay in about $100,000 per person for someone in their mid 50s to mid 60s. Although people buy this from age 40 to 70. But kind of in that range, you're going to earmark about $100,000 per person. So for a couple, about 200,000. We do have joint policies that'll cover both the husband and wife. Real popular option right now. But essentially, you're going to put in that 100K per person to set up a big multiplier effect for the long-term care benefit. Again, all tax-free as long as you use it for long-term care or the life insurance. And that's the hybrid. It's the hybrid of the life insurance and the long-term care. So let's say you buy this plan, you put 100K in, whether it's over 10 years or as a lump sum, and you never use it. A lot of times you're going to see a death benefit of 120 to 150 in return. So, if you can kind of think about it most simplistically, you're essentially getting return of premium to your beneficiary plus a little bit of extra. Of course, they're going to be using most of that interest that they're earning at the insurance company to provide those long-term care and inflation protection benefits. So I think, in a nutshell, long-term care provides you a lot of leverage, whereas the annuity provides you a lot of longevity, and then the DIY provides you a lot of control. So I guess if we had to make one recommendation, wouldn't we recommend, if you're able to qualify health-wise, maybe splitting the difference across, all three categories?
And I think for the most part, if you don't have a lifetime income and annuity or long-term care insurance, you're already doing it yourself. So for the most part, and we're not advocating you put anywhere near all your assets into an annuity or into long-term care insurance, but it's just a diversification tool. So, say you have a portfolio of $1 million, you might have $800,000 in the market. Leave it there. It's probably been doing pretty well for you, but you can allocate the other $200,000 to some combination of a hybrid long-term care insurance plan, or like a lifetime income annuity for the other 100K, or both. I mean, you could maybe put 100,000 in both. And, I guess the the lifetime income and annuity, it gives you a shot at more growth than the hybrid long-term care insurance. Because like if you die in your sleep and never need the long-term care, you pretty much get your premiums back with maybe 30, 50K more than you put in. But that was over 20, 25 years that the
Right. It's going
insurance
to be a
company
pretty
had your
bad
money.
return.
Yeah. The lifetime income annuity, if the indexes do perform well, there's a good chance that 100,000 could be two, three, $400,000. It could be a lot more than just simply that life insurance benefit. So, like I said, there's pros and cons with each, but that's really what Drew and I and LTC Tree, our team, specialize in. And we'll have a conversation with you. We'll help you drill down and kind of go over what is the pros and cons, and help you kind of judge for yourself which one you feel like might be most appropriate for you.
Yeah, and we are seeing a trend of more people, sort of opting to do multiple options.
Yeah.
Thankfully, right now markets are at literal all-time highs. It's a good idea to be rebalancing some of these portfolios. I think a lot of people have a lot more exposure in equities than they really know that they do. And so some of these sort of more conservative, but also leverage providing instruments are a good way to not have a big disappointment if there's ever a big downturn in the market. So I kind of look at it as we're sort of helping our clients rebalance their portfolios and just taking a little tiny chunk of it and moving it into something that's a little bit safer.
That's a good way to look at it. Yeah. Well, for those who want to get in touch with us, Drew, how do they get in touch with us? Do they go to our website? Do they call us? What do they do?
Yeah, all of the above. We talk to people every day on our 800 number and our website, LTC Tree. We'll put it in the show notes here on YouTube. And so, all right, today we talked about DIY, how you can just save your own money, put it into various inflation protected options. We talked about how you can do hybrid long-term care plans, whether it's over a lump sum or pay it over 10 years. We've got videos that drill down on those. And then we talked about the income annuity, which is kind of the newest entrant into the market that provides you that lifetime income guarantee that you won't outlive your resources. So we just wanted to kind of, a lot of people have these thoughts on their mind right now here in 2025, and we wanted to kind of talk about our thoughts on the differences of them. So thanks for watching, guys. Derek, we'll see you next time.
All right. See you guys. Thank you.